who joins us live from AlphaBroking. He's in our Melbourne studio this afternoon. Markus, great to see you there today. Markets at the moment just seem to be on steroids. As we know, it's sort of post-Donald Trump speech yesterday. Even though we've had very little sort of policy detail, it seems there has been enough in there to sort of spur on this rally again.
Well, that's right. Hi, Leanne. Look, I think Trump is reading, he knows his people very well. I mean, he sort of pulled the emotional card by his speech yesterday, and short of substance and full of emotions, which is great short term. It really spurred on a total positive vibe. Now, that's sort of coming on top of already a very strong rally in US asset prices. And I've got to say, I mean, to me, this whole US price behavior in US indices starts to remind me big time of the mid to later 80s. I mean, it's got this sort of madness feel to it, and not that I'm trying to call it top, this madness can go always further than you think. The bottom line is the price gains are massive, and the positive vibe out there is very strong. So my suggestion is to go with it for as long as you can, with eyes wide open, because the one thing that's really got to be watched is, of course, the bond market, which is the boss of financial markets. And bond prices have broken down on the 10-year notes in the US, are breaking down on the 30-year bonds in the US, so yields are rising, the price of the bonds are falling. And that is something, that's a combination that makes us obviously look towards the Federal Reserve in a couple of weeks.
Speaking of the Federal Reserve, I think the chances of a rate hike now have moved up to about 70% for this March meeting. And it seems now that the market wants to see rate hikes. It was a very different story last year when we spoke about rate hikes. The market would, get itself into a bit of a frenzy. But right now, given all this fiscal talk, post-Donald Trump, it seems like the market is ready for rate hikes.
Well, that's right, Leanne. I mean, all the economic fundamentals, all the data really is basically exactly where the Federal Reserve is in a situation where they've got to move. I mean, they're sort of in the target range in inflation data, economic output, employment. So generally, in a way, it's better to get it out the way while you can. What is interesting to note, though, is that the yield curve actually, if you go out over the next 2 to 2.5 years, is actually flattening. In other words, they don't see the federal funds rate that's currently in a 0.5 to 0.75 target range that might move with a 0.25% increase in a couple of weeks to a 0.751% range. The market does not see the federal fund or the short-term rates for Australian, like equivalent to our 90-day bill rate. They don't see that beyond 2% in 2.5 years, which is quite amazing when you think about where the economy already is and how strong things are. So essentially, whatever they're going to do in the Federal Reserve, if they actually get up as far as 2%, that is actually seen as quite a massive effort. So in perspective, obviously, that are really small moves in historic perspective. So we are really thinking rate hikes this year on the cards, but it will have to be seen what sort of impact we're going to see on the equity markets at pricing where we're at.
And, of course, not just the equity market, but the currency space as well, which you watch, I know, very closely, given the moves in commodities and so forth, the correlation there. If we are to see a move by the Federal Reserve, will that spark a correction lower potentially for the Aussie dollar?
Yes, we feel so. I mean, we had a good run from the 72s to the 77s. We're currently around the 76.5s. Look, it just feels to us a little bit, if you look at gold shares overseas in particular, they corrected quite strongly over the last a few days. It just indicates a little bit that they might be a little bit ahead of the pack of a correction in precious metals, and if you like, in commodities per se, inclusive your iron ores and your coppers. I mean, iron ore is around the $85 a ton basis April, and copper really has been disappointing over the last few weeks, especially in light of strike action in Chile and elsewhere. You would have expected a bit more price action. The fact that it didn't get on with the job indicates there might be corrective trouble coming. And essentially, these commodities does tell the story, obviously, for the Aussie dollar. So we think if you do see a pullback in the Aussie dollar, 75, 75.50 would be our target range. We're still very bullish overall. I think our technical technical and fundamental outlook on the terms of trade basis for Australia is very bullish for the Australian dollar. So we still believe a break of 77.5 is imminent. Maybe not straight away, but over the next few weeks. And we're still targeting 85 cents plus by mid-year this year.
Markus, it's Rudy Philippek van Dijk here, FN Arena. Good to see you, Markus.
Great to hear you, Rudy.
Markus, you just touched upon a few things like prospects of Fed interest rate hikes, gold and gold stocks. I mean, on my observation, gold stocks in Australia pretty much peaked around August last year. They've all gone, most of them have gone through quite what looks like quite a severe correction, and now this year they're all of a sudden making sort of a comeback. Do you think that those share prices can go back to where they were last year, or should we regard last year basically as the peak in this cycle?
Well, I think in the short term, I think there's a bit of a difference between the junior gold stocks to the. I mean, there's not that many majors as we know. Look, our feel is that in a moment, the pricing, if you look at your overseas gold stocks, such as Gold Corp or even a junior gold ETF, the FANEC junior gold ETF, which has been a really good indicator per se, well, that's giving us an indication that medium to long term, we are actually most likely in a new bull market. Short term, we really think there's a chance for corrections. The bottom line is we don't believe that the rate increases in the US will have a US dollar beneficial effect to the point where it really will hurt gold, precious metals and gold stock in a very big way. We think it will have a minor effect, and we do believe overall that any pullback in gold stocks is an opportunity to get on the bandwagon.
The other thing, of course, would be that if let's for the sake of argument say that interest rates will only move to 2% over time in the US, if inflation is probably around that level as well, that also indicates that on adjusted for inflation basis, interest rates would still be negative in the US, which is positive for gold.
Well, exactly. I mean, look, I think on top of that, if you overlay that with any potential geopolitical tensions, let alone a US-China bash, one way or the other, at least in words, if not in actions, look, essentially gold is at a reasonable price level. We like it. We're very, very bullish long-term, as you know. But look, to us, it could be potentially a perfect storm. But to be a bit more conservative, we need $13.50 broken in gold in US dollar terms. We need $20 broken in silver to really get excited on that. And we're still far away from that, but once we see these levels on a monthly close, then I think we got the confidence to load in a lot more.
Markus, you just mentioned a new bull market for gold potentially opening up. That effectively means, history shows, we should all be piling into silver, because they're going to outperform gold then.
Yes, absolutely.
I just want to have that confirmed. Unfortunately, we don't have too many silver stocks on the ASX.
No, we don't. But I mean, clients can invest in ETFs that have a silver bias, and I mean, there's so many really good ETFs out there nowadays that people can get in there via shares in a non-geared basis, because silver intrinsically is already a relatively geared commodity, if you like, so it tends to move quite extensively. So I mean, people can get good exposure in that, and obviously these resource stocks, lead and zinc miners, indirectly they also mine silver as well in the same mine. So indirectly they've got an exposure to silver like that as well.
South 32 is one of them.
Yeah.
Markus, let's talk the energy plays. I'm just going to sort of switch focus for a moment. It seems to be out of the limelight at the moment, but price action just seems to be trading in this sideways pattern right now. What are you seeing? What are you watching right now across the energy sector?
We are watching natural gas. I mean, there's some stories out that some nuclear reactors in the US have to be shut down for servicing, and they actually start going down a little bit down the German direction of actually reconsidering nuclear plants as well. But they're probably, with Trump in place, that's probably going to be put on hold. But there's going to be servicing happening. So they're talking about a lot of gas will be needed to cover for the energy shortage for related gas plants. But we shall see that. Generally, natural gas to us had a great price behavior over the last last 12 months. It corrected the last 3 months beautifully, if you like, if you're a bull like us. We are long natural gas again for the last few days. We think that's a commodity that's somewhat ahead a bit of its bigger brother, which is West Texas Intermediate crude oil or Brent oil, North Sea Brent. But look, really, we feel what's happening in... so we like natural gas, but if you look at oil stocks, if you look at crude oil itself, we've got this big hedge fund play out there with an enormous amount of long positions. We're trading between $52 and $54 on West Texas Intermediate now for 3 months. So it is a bit the untold little elephant in the room, if you like. I mean, at some point, this thing will obviously move. Now, we are long-term bulls. We made it very clear. We're opportunistically placed to one way or the other, but we basically would like to see lower levels, maybe a $48 level in oil or even a bit lower, for us to be able to get our hands into is a bit more. Oil stocks in the US, like your Chevron, Exxons, and also in Europe, Royal Dutch and BP, indicate there could be more downside. But so far it's gone sideways. So it's a real paradox, and there is a big play in crude oil futures with hedge funds. So we believe after 3 months of sideways actions, we're going to get an answer very, very soon. And I recommend clients to hold off and wait to see what that is.
What would you be doing with some of the energy stocks? Do you like any of them at the moment, Rudy?
No. I think it's... I totally agree with Markus. Markus, did you hear it? I agree with you. I think people automatically assume that the only way is up here, because essentially the Saudis wanted to be up because they have a big IPO to place this year. But the big question mark still remains: what's going to happen in the US with production? And it would appear that those guys can produce at ever lower levels.
All right, we're watching a lot of those. And as always, it's been wonderful talking to you, Markus, across all of those commodities. Do appreciate your time. We'll look forward to talking next week again.
Thanks, Leanne.
Bye, Markus.